Hey taxpayers, it's Tiffany Gonzalez, CPA here, founder and CEO of Accounting to Scale. It's story time. I recently came across a scenario that I think might be helpful for you and your business. The scenario is business owner buys a business. First couple of years, they're struggling like most businesses and they take on debt to stay afloat. As true entrepreneurs in the pandemic, they pivot and they end up making a large profit. Now they're wondering what they should do with that profit. How can they limit their tax liability? Should they purchase a company warehouse? And can they lease luxury cars? All really great questions. So what do you think my response was? My response started like this. Some financial advice isn't necessarily good tax advice, and some tax advice isn't necessarily good financial advice. There are businesses that every year spend much of their profit on high operational expenses. They do this with an incentive to have minimal tax liabilities, but this actually hurts them because at the end of the year, they're left with no cash. Their business doesn't look very profitable. Sometimes it is better to pay Uncle Sam some tax to have a more profitable business and to show cash on hand. Cash that can be used to purchase and invest in future assets. I ended up recommending them the following. Pay down some of that debt that they've incurred during the initial part of their business, starting with the highest interest rate debt. This will help alleviate the ongoing cash flow and will reduce the overall interest they will pay. I did recommend that they start looking into that company warehouse, but that they consider financing it instead of purchasing outright. Right now, interest rates are super low, so if you can find a long term, your payments will be very low on an ongoing basis. You see, commercial buildings are depreciable over 39 years. So even if you purchase the building outright, you wouldn't get the dollar for dollar 100% deduction in the same year. That deduction would still be spread over 39 years, making financing look like a much better option. So my advice to them isn't necessarily going to dramatically decrease their tax bill, but it is going to make their company financially better. They'll have less debt, so they will have more leverage in the future. They will pay less interest over time, money that they can use on something else. They'll purchase an asset that'll make their books look even better. The net worth of their company will increase and they will look extremely valuable to any bank or any investor in the future. About those luxury car leases. Well, I recommended that they first open up a company 401k plan. Not only will this be a great benefit to their employees and help them retain top talent, but it will also allow them to save for retirement and really maximize their contributions. You see, a 36-month lease in a Porsche is very nice, but you know what else is nice? Retiring early. Full disclaimer, this advice may not be the right advice for you. Financial planning is not one size fits all. If you have specific questions and would like specific advice, please reach out to our office and we will offer you a consultation. If you loved this video, hit the like button, subscribe to our YouTube channel, and follow us on LinkedIn, Facebook, or Instagram. Until the next video, your favorite CPA, Tiffany Gonzalez.